This video will walk you through the solution to exercise 17-6, which focuses on accounting for share issues and repurchases. Here's the data for our problem. Tanizaki Enterprises reported the following share transactions during 2026, its first year of operations. On January 15th, the company issued shares. On March 30th, it reacquired and canceled shares. And on July 31st and October 31st, it did the same. It issued and reacquired and canceled shares. Our requirement is to prepare the journal entries to record these transactions. So let's begin with a January 15th issue of 150,000 no-par common shares at $25 each. This is a relatively easy entry. The company is going to debit cash and credit common shares in the amount of $3,750,000, calculated as 150,000 shares issued times the $25 issue price. Then on March 30th, the company reacquired and canceled 10,000 shares at $20 a share. When reacquiring shares, that's going to result in a reduction in the common share account by the number of shares multiplied by the average issue price up to the date of reacquisition. So the company reacquired and canceled 10,000 shares, and the average issue price to this date is based on the initial issue price, which is $25 per share. So it's a total of $250,000, and that's the debit to common shares. Now let's leave a space and go for the easiest item of them all, the cash. The company is going to pay $200,000 to reacquire these shares. That's 10,000 shares times the $20 amount paid. To make the journal entry balance, we're going to need a credit. And the question is, where does it go? And this is very important. In this case, the company is paying $20 to repurchase shares that it issued for $25. So the company is paying less for those shares than it originally received for them, which might suggest that the company made some money or profited off the sale of its own shares. Well, companies cannot record gains or losses on transactions related to their own shares. So this credit cannot be to any sort of revenue account. Where it goes is to an account called contributed surplus. So the entire difference of this transaction of $50,000 is going to be credited to contributed surplus. The next event happens on July 31st, where the company issues another 20,000 shares, this time at $22 each. So the company is going to debit cash and credit common shares for $440,000. That's 20,000 shares times the $22 issue price. Then, on October 31st, the company reacquires and cancels 15,000 shares, this time at $29 a share. So once again, we're going to have to debit the common share account for 15,000 shares times the average issue price to date. The average issue price of shares will only change when the company issues new shares. And in this case, the company issued shares twice at two different prices. So the calculation here requires us to start from the beginning where we had 150,000 shares issued minus 10,000 shares reacquired times $25 a share. That's a total of $3,500,000. And then add to that the 20,000 shares issued at a price of $22 a share for a total of $440,000, resulting in a numerator value of $3,940,000, then divide by 160,000 shares outstanding, results in an average issue cost of $24.625 per share. So when multiplied by 15,000 shares reacquired, that's a debit to common shares of $369,375. We'll leave a couple of spaces. Cash is the next item we can deal with. It pays $29 to repurchase 15,000 shares for a total of $435,000. Now the next part is very important. If the company had paid any amount less than $24.625 per share, the difference in this transaction would all go to contributed surplus. But in this case, it paid more than the average issue price. It paid $29 when the average issue price is $24.625 per share. So in this case, what we must do first is look for any existing contributed surplus balance relating to the same type and class of shares. We know from our previous reacquisition that there was a credit to the contributed surplus account, so now we must remove that entire balance of $50,000. So we'll debit contributed surplus for that amount. After that, any leftover or remaining amount is then debited to retained earnings. So to make this journal entry balance, that's $15,625. And now we're done with this problem.